Welcome to Supernatural Stocks with your host, the Finance Ghost, your weekly fix of local and international news for investors and traders alike. These are the stories that really caught my eye in the past week. Let's jump straight into international news, and I'm afraid it's going to be a dangerous one for anyone listening on an empty stomach. The quick service restaurant or QSR sector has gotten plenty of attention from investors over the years, perhaps because of familiarity bias with the brands. We all know and love them, right? Those golden arches late in the night, a beacon of hope. Now this is your typical takeout mixed with basic seating arrangements, as opposed to full service restaurants that seat and serve you and frankly make most of their money from alcohol. If you're buying your food at the counter, you are in QSR territory. Now, a very good example of this is Yum Brands, which owns the likes of KFC and Taco Bell. That share price has returned a compound annual growth rate, so that is the rate per year, over 10 years of 6%, and of course that's in dollars. On top of that, there's a dividend yield of around 1.8%, so your total return would essentially be those added together, depending how you look at reinvestment of dividends. Not great returns, but not bad. Over at McDonald's, it does get a whole lot tastier with a compound annual growth rate, or CAGR, of 10.4% over 10 years, plus a 2.5% average dividend yield as well. Restaurant Brands International, they actually have the ticker QSR, rather clever. They own Burger King along with a few other brands. They only listed back in 2014, so we don't quite have a 10-year CAGR, but it's close enough, coming in at 6.9%. Their dividend yield has averaged 2.5%. Now the S&P 500, that's the broad market index, over the same period that's returned 10.2% and paid an average dividend yield of 1.7%. So only McDonald's has actually outperformed the index out of those three. There are of course really big outliers like Domino's Pizza with a 21.8% CAGR. Look, you barely need to care about the dividend when you're seeing returns like that. And for those who enjoy trading, you may well want to check out Starbucks. It's been smashed down to around $74 a share after releasing poor numbers, which also happens to be where it bottomed out in June 2022. And it's not much higher than the $68 we saw at the bottom of the pandemic. So those who like to punt at important support levels, that might be one to look at. And this leads me into why I'm raising this sector at all. Because at the end of the day, things are tough there right now, and that's what has dropped Starbucks' share price, but also put the others under pressure as well. Aside from that negative surprise that Starbucks served its investors last week, there was also the headline-grabbing commentary from McDonald's that they need a street-fighting mentality to win in the current environment. Much as they've just reported their 13th consecutive quarter of positive comparable sales growth, there is clearly a slowdown, and it's not just in the US. Where they are seeing growth, it's generally in the value-focused meals. You know, those feed a family of four for $120 kind of thing. Which is where taste may vary, but at least nobody is going to bed hungry. The pressure is being seen across the board in the QSR sector right now, and that is a pretty good indication of the level of consumer pressure out there. Even if you don't have a position in any of these stocks, they are worth keeping in mind just as a barometer for how consumers are doing. And if you're looking for a way to play this sector locally, I think Spur would be my choice there. For those among you who do enjoy looking at important technical levels, have a look at that Spur chart over the past year. The business is doing really well, and that share price moved up very, very nicely in mid-2023. It then struggled to break above around $29 a share for quite a while before moving higher again in December 2023 on more good numbers. And since then, it's been washing away a little bit. A couple of times it has dipped back down to around $29 and then jumped up again. So something to keep an eye on. I think that the Spur management team is doing a pretty good job of delivering right now. This is a solidly cash generative business, and they make some pretty smart acquisitions as well. So as I say, for those looking for shorter term positions and a little bit of swing trading, that Spur share price may be one worth looking at. That fast food update wasn't exactly great on an empty stomach, but this next section is not suitable for a weak stomach. The MTN share price is a rollercoaster ride of note, with the group chasing growth in markets that are exceptionally good at giving people headaches. Goodness knows there's been plenty of volatility along the way, but it does say something that the MTN share price is now trading in line with where it was in 2007, at the top of that bull market. That is now 17 years ago. The early days of cell phone adoption were fantastic for the networks, but as smartphones took over and our communication moved from voice to data, the days of it costing a fortune to stay in touch started to disappear. I now spend much less on my cell phone contract per month than I used to spend a decade ago, and that is without adjusting for inflation. Now, this is very tough for the telecoms businesses, of course, which is why they've looked for growth in new markets in Africa and through providing additional services like fintech. It can work, as we are seeing in MTN Ghana, where profits are up 49.3% for the quarter, an exceptional growth story even in the context of inflation of 25.8%. Best of all, capital expenditure came in 23.3% lower there, so free cash flow is smiling. But over at MTN Nigeria, it's completely the opposite situation. The rapid depreciation of the naira is causing havoc, especially because so much capex is denominated in US dollars. Trying to earn revenue in naira while rolling out network upgrades in dollars is a fool's errand. The group will have to make changes to its strategy, as the forex losses in MTN Nigeria were so severe in the latest quarter that the business now finds itself in a negative equity position. These telcos are in a tough spot because the underdeveloped markets with the best growth prospects and the lowest penetration of telecoms and mobile banking services are inevitably volatile places with particularly vulnerable currencies. I don't have a position in this sector, and I don't see that changing. As a further nod to telecoms, but at a completely different point in the value chain, we close with Apple, which has just released its second quarter results. The theme here is that services revenue is growing quickly and products have somewhat stagnated, admittedly against a tough base quarter in which they caught up on supply chain backlogs and had a particularly strong period for iPhones. But still, even if we look over 6 months and across the full hardware offering to try and take out some of the noise, what we find is that revenue is down 4% for the 6 months. Conversely, services revenue is up 12.7%, thanks to the ever-increasing installed base of devices and price increases for services. The services business operates at a vastly higher gross margin than products, so that mix effect is actually positive for shareholders. Still, I'm worried about Apple. The incredible outperformance of this stock over the past decade or so was as much due to multiple expansion as it was to earnings growth. The multiple cannot really expand much more than this, so we need to see proper growth now to drive that share price forward. And what will be the next smartphone? Will it be the Vision Pro VR glasses? Honestly, I'm not convinced at all about mass adoption of that stuff. This is why Apple has now announced a major share buyback program, which obviously drives earnings per share, but I am starting to worry about whether or not Apple can keep up with the other players in this sector. And if you made me choose between Apple and Microsoft, it would take me a nanosecond to choose Microsoft. That's it for this week. Thank you for listening to Supernatural Stocks with your host, The Finance Ghost.